using options. Here's a strategy called a straddle. In a straddle, you buy a call and you buy a put at the same time. All right? So, can you think of when this might be an appropriate strategy? Because ultimately, running these numbers is very straightforward. It's more a question of when would it be appropriate? Those of you that had options. When do you think a straddle, and you can figure it out by just looking at the graph edge. When would be an appropriate time to consider a straddle? Do you have an answer? Yeah?
You're not exactly sure whether the price is going to go up or fall down.
All right, so the bottom line is if you thought the stock was going to be very volatile,
Yes.
all right, so it's going to swing back and forth, that would be an appropriate, this would be an appropriate strategy. What's the downside to this?
The price remains flat.
There you go, right? If the price remains flat, you're going to get caught. This is like the region of death, right? These are huge losses. If the stock stays flat, you end up losing on your call and your put. So you just get hammered twice, right? So this is actually kind of dangerous if you don't construct it in such a manner that that region, so this is your loss region. So it's roughly between, looks like between maybe 370 rupees on the downside, and maybe like around 510 or so on the upside. All right, so if the stock is going to stay in that region, you're going to have a loss. That's a guarantee. So you want to construct it so that region is as narrow as possible. All right, so, and when you do that, and that V closes, the only problem is that loss region gets even deeper. So you have to be careful about that. All right, so that's as far as options go. A little bit about forwards and futures. Again, do you have, how much time do I have? I don't know. Do you have classes to get to?
No, sir, you can carry on.
Okay, all right, very good. All right, so let's talk about forwards and futures. Remember that the only difference between a forward and a future is the fact that forwards are traded where? OTC, right? Whereas futures are exchange traded. Apart from that, they're all very, very similar, right? But the difference is, it's a contract. So you can take we'll just take futures markets. In futures markets, you can take what's called a long position or a short position. If you take a long futures position, what you're doing is you're locking in the price at which you can buy a commodity at some future date. But it's an obligation. If the price goes down, you have to buy at the higher price. And if you take a short position, you're locking in the price at which you can sell. But again, the problem with that is, even if the price goes up, it's a contract. You have to sell at the lower price. So that's the important thing with futures. All right, so futures are standardized. Why don't we go to the next slide? Again, really for these markets to work, you need hedges and speculators. But we'll focus on the hedging side, which is the long and the short. All right. But remember, when you have a long who thinks, why would you take a long position in the futures market? Why would you lock in the price at which you can buy something? If you thought, right? Exactly. So if you were, let's say you make cornflakes, right? So is Kellogg here locally, domestically? Kellogg? Yeah, all right. So if Kellogg is manufacturing locally and they want to lock in, they think prices of corn are going to go up, all right, they would use a futures contract. Okay? Whereas the short position might be of interest to the farmer. He wants to lock in the price at which he can sell the product. Okay, go to the next slide. Again, a couple of things to note. Generally speaking, you've got to make some sort of a margin deposit. We talked about long versus short. In India, all these futures contracts are cleared through the NSCCL, or it's a National Clearing Corporation of India. The other thing that you should be aware of with futures contracts is there's this thing called daily settlement or marking to market. What that means is, well, let me ask some of you, what does marking to market mean?
Daily settlement basis.
Meaning what?
Like suppose if an investor invests some 10 rupees and if the price has been gone up by 12 rupees,
Right.
the other person in his account 2 rupees gets decreased.
Exactly. So in other words, the profit or loss is actually booked to your account. So it's not a paper loss, right? It's not a paper gain. It's an actual booking of profits and losses to your account. And that doesn't happen with any other account. Like if you have an account with your broker, all right, and the stock goes up by 20 rupees, that's only a paper profit, right? Until it's actually booked. In other words, you actually have to sell the stock to gain. So in the futures markets, the contracts are marked to market daily, which is a huge risk management tool. It actually minimizes risk in the futures market. All right, let's go to the next slide. All right, so again, a little bit of background on futures in the Indian market. Again, it's the same as kind of the options. The main option is the Nifty. Same 133 stocks, and if you want to know which ones they are, you just go to the NSE website and it'll list the 133 stocks that you can trade futures on. One thing you might have noticed in the very first slide, when we looked at interest rate derivatives, one of the ones listed was, I think on the OTC we had swaps and forwards, and we had interest rate futures, all right? They do exist, and they're traded on the 10-year Indian security and the short 90-day, 91-day T-bill. They do exist, but I'm not exactly sure why. They are not very popular in the Indian market. They're not very liquid. Okay, and I say I'm not sure why because in the U.S., the contracts on U.S. Treasuries are extremely liquid, very, very widely used to manage risk. So yeah, so maybe, I don't know, maybe that's a research topic for you folks to figure out why in the Indian market the Treasury futures are not very very popular. Does anyone know why that's the case? All right, so we'll have to do some research on that. All right, next slide. So this is the main thing you want to keep in mind, all right, about how you use futures, or for that matter, any derivative to manage risk. Because ultimately, when you go out and you work for a financial services firm, or when that even a corporation, essentially all you have to understand is how do I use options, futures, and swaps to hedge risk, all right? And in principle, it's actually pretty straightforward. So take a look at that list. It says identify your risk exposure in the spot market. So let's start with a simple example, which is in the stock market. All right, so you're a portfolio manager and you own a stock portfolio. What is your risk exposure? So what is it that you are frightened of? No one owns stocks here? It's very, if you buy a stock, right? What's your worst case scenario? Goes, that's it, right? So that's your risk exposure. So if you're a stock portfolio manager, what's your risk exposure? Stocks go down and you lose money. That's it, very simple. So the first thing you have to do is identify your risk exposure of whatever you hold, all right? So it's easy with stocks. Have you all had classes in bonds, investments? No, anyone had a class on corporate bonds, fixed income securities? No. Okay, so I guess that might be. Let's not talk about. All right, so let's just talk about equities then, all right? So you've identified your risk exposure in the stock market, and that is stocks are going to go down and you're going to lose money, right? So then what you want to do is ask yourself, what sort of position I take in the futures market, derivatives, to offset that risk? So let's talk options, all right? if you own the stock, if you're a portfolio manager, what would you do in the options market to help manage your risk? What would you use? So you would use calls or puts? Puts, remember, we looked at the profit profile? It gives you like a hedge. So with options, what you would want to do to manage that risk exposure is buy puts. That's easy enough, right? What about in the futures market? Short or long? Long? So it's not very clear. But again, in your mind, this is how you're going to have to answer the question. You have a loss exposure in the stock market, right? You have to ask yourself, what do I do in the futures market that will offset the loss? If the markets fall, I'm going to lose money in the spot market. What shorter position do I take in the futures market? Well, think about this, right? If you take a long position and stocks fall, what's going to happen to the value of your futures position? It's also going to go down, right? So your spot position is going down and your futures position is going down. So all you've done is double your losses. That's not a hedge. So if you take a short position, what happens? You're locking in the price at which you can sell, which means as the price of the stocks go down, the value of your position actually goes up. And so as your stocks go down and your futures go up, you got a hedge. That's the opposite. That's it. That's all you got to think about. It's actually relatively straightforward. What do I do in the derivatives market that will offset my position in the spot market? That's it. All right. It can get a bit more complicated, which we won't get into that. And if you ever get into the situation where you're actually working in derivatives, you will actually have to figure out a hedge ratio and stuff like that. But as long as in principle you understand what hedging is about, the mechanics are actually pretty straightforward. Okay, so go ahead. Yeah. All right, so this is just a numerical example of what we just talked about. All right, so here's a case where we're saying that let's say on August 30th, you had a portfolio worth 273,519 rupees, right? You take a position in the future market. So on that date, there was a nifty futures contract trading at 510 cents. Can I say? Here's something you have to be familiar with. Again, you can go to the NSE website for this, but all these contracts have a multiplier. Did you cover this in any of your classes? Right? So for the Nifty, the multiplier is 50. In other words, to figure out the value of your contract, you've got to take the futures price multiplied by 50. That's it. All right? So that's the value of your futures contract. So 50 times that, one contract, that's the value of my futures position. Fast forward to at the end of November. All right? So it looks like prices have fallen. So that's what the Nifty futures contract is trading at. So that's worth about 254,000 rupees. Your portfolio value in the meantime has fallen to 254,000. That's the difference in the futures position. That's the difference in your stock position. The only thing is, if you take a short position, you actually have a gain, all right, of this much. And you lose 18,000 of the portfolio. Effectively, you offset your loss with the futures position. It's not a perfect hedge. In this case, you actually come out about 2,000 rupees ahead. But that's essentially how it works, right? You lost on the spot position, but you gained by going short with the Nifty futures. Okay, if you go to the next slide. All right, so these are the ones I'm going to skip past because this talks about how you can hedge a bond portfolio. But I think most of you told me that you haven't talked about valuation of bonds, you haven't talked about duration of bonds, am I correct? Yeah, so let's just skip past these then. Can you just to the next slide? And the next, yeah, just keep going. Next one. Next one. Keep going. All right. again, it's not that it's impossible to understand, but it doesn't make sense if you don't have the background for me to try and explain that to you. That would be something, maybe if I came back and did a class, then we can actually spend time on that. All right, so we've talked about options and futures. Let's talk a little bit about swaps. All right. Again, so pretty widely used. In India, in terms of swaps, we've got interest rate swaps, currency swaps, and credit default swaps. And the other thing that the RBI requires is that if you enter into a swap, remember, which is OTC, one of the entities has to be regulated by the RBI. All right, so there's two parties in a swap. RBI regulations require that one of the parties is actually controlled by or regulated by the RBI. So if it's two non-RBI regulated entities, a swap is not permitted. Right, so that's one thing to keep in mind. Okay, next slide. So we'll talk about two kinds of swaps: an interest rate swap and a currency swap. All right, and then we'll round off with the credit default swap. So in an interest rate swap, essentially what happens is, let's say that, I think we'll use this example. I think I used the example of Randbacks, right? As you'll find out, essentially what you do in an interest rate swap is you swap fixed payments for variable, or maybe variable payments for fixed. That's essentially what an interest rate swap is. Keep in mind that, as odd as it sounds, it's a huge market. All right. So in 2011, 2012, the notional value of interest rate swaps was 51 trillion. All right. So that's 51 and 12 zeros. How many crores is that? 51 and 12 zeros. All right, so you can tell me at the end of the class, Peter. What's that?
52 lakh crores.
52 lakh crores? Okay. So that's a lot of money, I guess, right? Okay? All right. All right, so remember I said an interest rate swap is swap of fixed for a variable rate? Overseas, the common variable rate is called the LIBOR, the London Interbank Offer Rate, which is what? You look like you knew what it is?
Banks do trade in between them.
Exactly. So it's an interbank rate, right? So it's a short-term interbank rate. So it's really the lowest possible interest rate, treasury rate. So it has a little bit of credit risk involved in it because it's not the government, but it's the purest form of a short-term interest rate after the government bond. So in India, the equivalent is the Mumbai interbank offer rate, or the MIBOR. All right, so let's go to the next slide. All right, so here is an example. All right, so I don't know why this happened, but I actually had a rupee sign over there, but I guess the software didn't pick that up here. Okay, anyway, I was quite proud of the fact that I could find a rupee sign, but anyway. All right, so here's an example of what I was talking about. Let's say that in this example, Ranbaxy has borrowed money from Axis, all right, for 1 year, for 25 million rupees. The interest rate on that loan is variable, MIBOR plus 1. Right? So in other words, in this case, Ranbaxy has borrowed 25 million rupees for 1 year from Axis, but the interest rate is variable, MIBOR plus 1%. So the risk over here for Ranbaxy is what? The interest rates go up, right? So if you go to the next slide, all right? One way that Ranbaxy can manage this risk is to enter into an interest rate swap. So let's say it approaches Bank of America, all right, NA. It says, listen, I want to manage this interest rate risk. So, and Bank of America says, fine. If you want to enter into an interest rate swap with me, the fixed rate that we're going to quote you is 9.5% fixed. Remember, this is an interest rate swap, all right? So in this swap, what Ranbaxy is agreeing to do is pay Bank of America 9.5. It's a swap, right? In return, Bank of America pays it MIBOR. Right, so that's the swap. Now, if you skip, here we go. This is the net effect of the swap, all right? This explains it better. So here's a case where, all right, Ranbaxy borrowed 25 million rupees from Axis, interest rate MIBOR plus 1%. It's concerned about rising interest rates, so it goes to Bank of America and enters into an interest rate swap. And the interest rate swap is, we pay 9.5. I'm sorry, Ranbaxy pays 9.5. In return, Bank of America says, we'll pay you MIBOR. Look at the net effect of the swap. All right, the MIBOR payments flow out this way, plus 1%. The net effect is that Ranbaxy has been able to lock its interest rate into 10.5. Because it's 9.5 plus the extra 1% it pays out on the other side as well. So what has it done? It's taken a variable interest rate and converted it to a fixed rate. So what the challenge, of course, that if you were involved in this swap is to figure out what kind of swap can I get into that will give me an interest rate that I'm comfortable with. All right. So in other words, it's going to be worthless if you're paying MIBOR plus 1, but the terms of the swap are so tough that when you look at the lock rate, it's like 15%. And then you say, what's the point? I mean, maybe interest rates won't rise that much in 1 year. Right? So you have to negotiate, obviously, with a bank that gives you a competitive effective interest rate. So that's basically what an interest rate swap is. Okay, so this one, it's a little out of order. Could you just skip forward a little bit? Skip forward, yeah. Keep going. Keep going. Keep going. Yeah, all the way. All right, so here, I want to talk a little bit about a currency swap. It's a bit more complicated, all right? But let me set up an example. This is kind of realistic, all right? Reliance, as you're aware, has an energy wing, right? What is it called exactly? Reliance Energy, perhaps? All right? Is that what it's called? The energy arm of Reliance. Reliance Energy, that's it, right? Reliance Energy Limited. All right. So that's who we're actually talking about over here. So Reliance actually, the energy wing is planning an expansion into the U.S. And the reason is, have you heard of this thing called fracking? Any of you heard of that? It's very interesting. What they have found is technology that can extract gas and petroleum from shale, which is rock. Previously, there was no technology. Now they've found the technology that literally can go down, turn, and go that way, and actually extract oil and gas from rocks. All right, so it's a huge bonus to the areas where shale gas is available. That process is called fracking. Right, so there are disputes about environmental effects and so on, but the bottom line is everyone is trying to get in that business, including Reliance. So Reliance truly actually wants to set up operations in the U.S. so they can get involved in the fracking business. All right, so this is the scenario. So let's say that Reliance needs $100 million to fund this expansion in the U.S. market. Reliance is well known in India, but not as well known in the U.S. Right? What that means is if Reliance goes to a bank in the U.S. to borrow money, they will quote at a higher rate. Why? Because it's an overseas company. Most people don't know it, so they add what's called a credit premium to it. So that's where these currency swaps come in. So let's say that if Ranbaxy went directly to the U.S. market and borrowed, it would have to pay 8.9% U.S. rates. So 8.9% on the $100 million loan. So how to get around this? what you can do is enter into a currency swap in India. All right, so let's say HDFC is the bank. All right, so what HDFC would say is, all right, here's the way to do it. In India, you're one of the best known companies, right? If you're very well known, you get the lowest interest rate. So do this. Borrow Indian rupees and convert them to dollars using a currency swap. And the net effect will be you'll end up paying less than 8.9%. That's the basic idea behind the currency swap, all right? So let's say that these are the terms of the swap. So first thing it's going to do is to borrow, in this case, it needs the equivalent of $100 million, all right? So that's about 6 billion rupees, right? So 6 and 9 zeros. There you go. 6 billion rupees. So it's got about 6 billion rupees domestically. And let's say that the rate is about 14.45%. And this is based on, which is about true, I think. The exchange rate is about 1 to 60 there right now. So it's borrowed the rupees. Now what it's going to do is get into a swap with HDFC. So HDFC is going to say, all right, you give us 6 billion rupees, we'll give you 100 million rupees, $100 million. On that swap, all right, so look at what's happening. Reliance is giving 6 billion rupees to HDFC, right? That's almost like a loan. So on that leg of it, HDFC is agreeing to pay 14% fixed on the 6 billion rupees, right? HDFC is giving $100 million to Reliance. He has to pay interest on that. And let's say HDFC says, all right, you pay us 8% on the dollars.